All right, so I don't know if you guys know this, but Robinhood has been making some strides. Their goal is to be the top platform when it comes to setting up a brokerage account and investing in stocks for a typical investor, especially somebody that needs to do it mobilely. As a matter of fact, in December of last year, they released some new things that they're gonna be adding to the program, including a high APR debit card that's in competition with a lot of the APRs of a lot of savings accounts that are easy to obtain. And there's a few other updates that they've included, but the one that I wanna focus on a lot is drip. You might know what drip is. You know, some people come through places dripping and some people drip a little too hard, and it's really sad. I thought that was funny. Actually, I was laughing about it while I was thinking about what I was gonna say. Okay, yeah, that's not true, oh well. So if you haven't already, go to your kitchen, get your Folgers or your Starbucks or whatever coffee grounds you got, make you some coffee, sit back, because I got a lot to say. Well, not really a lot, but enough to say some important things. So seriously, let's get to it. Okay, I feel bad. Honestly, this isn't even coffee, this is water. I went out to breakfast with some people this morning and I had a latte because I was feeling bougie. Okay, let's go. What's going on, guys? This is Darren Jackson, and today we're gonna talk about drip. So to reflect a little bit on the last video, what I previously talked about was dividend investing and how I've been implementing that for the past almost year or so. And at this point, if you're similar to me or dividend investing has been something you've been doing for even longer, then drip may be something you're gonna be interested in. But before we get any further, we obviously have to answer the most important question at this point at least. What is DRIP? So DRIP stands for Dividend Reinvestment Program. To better explain this to you, let's reintroduce Company X. So from what we left off with Company X, they are a juggernaut at whatever they do. That part really doesn't matter right now, but they've been killing it. So at this point, you have multiple shares of stock within Company X. Let's just say you have 10, and to make things a lot easier, let's just assume that Company X is one of those rare occasions that actually pays you off every month, and they pay you $1 per month in dividends. That's rare occasion, but we're just gonna assume that's what it is from this point on. And now when you get those monthly dividend checks from Company X, you have a few options. Option one, you can leave it into your cash balance and either direct deposit it into your regular checking account, or eventually put it into your Robinhood's debit card and use it from there. On a side note, I have an Acorns debit card, but I actually did put myself on the waiting list for the Robinhood's debit card. Honestly, man, pressing that button, it's an Olympic sport, but I'm probably gonna talk about Robinhood's versus Acorns debit card later and why I may transition over, but that's totally gonna be something later. So anyway, you have that option. The other option, and that's definitely more preferred if you're an investor like me who only has about a 4-digit portfolio in their stock at this current moment, or maybe even less, is that you want to take those funds that you received in dividend checks and put them right back into the stock market. Or specifically, which is your third option, you can take those funds and put them right back into the company that you got them from. So if you're getting funds from Company X, at this point, if the breakdown is how I said it was, that means every year you're getting $12 per share per year from Company X. So let's say you own 10 shares, that's $120 a year. So you can take that money that came directly from Company X and put it right back into Company X, which can have some benefits. And now what Robinhood is implementing is that you're able to select individual stocks and enable this setting to where every time you receive dividend checks from that company, they go right back into that company, which is pretty cool. Another thing they're actually rolling in is something called fractional shares, which will make all this even more possible. Unless you just have a crap load of that similar stock, then, you know, good for you, and I envy you. Okay, never mind, that was me, I'm sorry. But anyway, what fractional shares allows people to do is to invest literally fractional amounts of the share, which is gonna be beneficial for people who want a piece of the pie of juggernaut companies such as Amazon or Alphabet, or even companies like Berkshire Hathaway. That was a joke. If you really don't know why that should be funny, then look it up. I'll leave the ticker right here. It's gonna be right there, so pull it up and you'll see why that would be pretty sad, unless your fractional shares are like in the thousands. You may not want to worry about that. But overall, it'll definitely be beneficial for people that want a piece of those large companies that know they're going to grow over time. So that automatic transfer from dividend checks going into your stock portfolio, going back into that stock, is DRIP. So now that we know what DRIP investing is, that leads us to the next question. Should we implement DRIP in our investment strategy? So when I'm stuck on a decision such as this, because this can alter how you invest overall if you stick with it or you decide not to, I decide that I would like to make a pros and cons list. Super generic, but so let's talk about it. So the pros of DRIP, there are a few of them. One, it does result in less attention to specific stocks. So now if you know you're implementing DRIP into a stock that is very healthy, such as Apple or currently Tesla, I don't know how long it's gonna last, but that's neither here nor there, then DRIP investing in a company like that may be beneficial for you. So not only are you gonna be consistently seeing an upwards increase in the worth of your stock itself, but you're also going to be consecutively receiving dividends that may increase over time as a corporation of Apple notices that they're receiving an increased amount of their excess income. They'd be more willing to give the shareholders more in dividends. So you're going to be seeing an increase in dividends in the long term, which will result in more money going back into Apple, which in over maybe a long period of time, or of course depending upon how many stocks of Apple you have at that time, can result in you having more stocks of Apple, which can result in you having more dividends of Apple. All right, and the second pro only applies to people that are investing directly into the company, not through a brokerage account, which will probably, as far as I know, which will probably be only possible if you work with that company. And if I'm wrong, please drop a comment below and explain to me how that actually goes down. But if you do invest directly into a company and you set up DRIP investing with that company, then they actually offer you discounts on their stocks once you have money that goes back into that particular stock. So the reason why I said I believe it's only when you work for a company is that's pretty much what's happening to me, for example. So I work for a particular company, we're just gonna call it Company X, and every month I have funds that go into my 401k, and part of my 401k is being a shareholder of the stock of Company X. What I've been noticing is that every time I receive dividends from that company, those dividends go directly back into my brokerage account part of the 401k. But what I'm also noticing is that when I make that purchase of those fractional shares of stock with that dividend, that the total amount of that share of stock is actually a lot less, or not a lot less, but a bit less than what it was. And over time, that's gonna result in me having more of a gain as opposed to if I invested it through Robinhood, which won't give me that discount. So that's benefit number two. And honestly, guys, that's all the pros I have, so we can't have more couch time. And mind you, these are my personal opinions. I'm not a licensed financial analyst. I could be wrong. Again, if you know of any other pros of DRIP, please drop a comment in the description below. I love having these conversations. Now let's unfortunately go somewhere a little less comfortable and talk about cons. All right, and now we have the cons, the negatives, the not sure if I'm feeling it. Kind of like your least favorite episode of The Office, Scott's Tots. Seriously, I always try to skip that episode, but I accidentally watched it yesterday. But anyway, so con number one, and granted, these are my opinions, my personal opinions on DRIP investing. If you do decide to utilize DRIP investing on specific stocks, you may experience less flexibility on what you want to use your dividend checks for. So the dividend checks that you're receiving from these companies, you may have recently had plans to utilize them towards other companies that may be a little healthier, or companies that you're personally excited in, or companies that open their first IPO and you really want to go on and get your foot in the door before everybody else does. But unfortunately, your dividend checks are going towards other companies that you may be interested in, but you're not trying to show as much love to at the moment, especially if those companies aren't doing so well, which is reason number two. DRIP investing can be a little risky. Now, granted, DRIP can be a great thing, especially if you know that the stock that's being reinvested into is a very healthy company like Apple, like Starbucks, like Amazon, Google. Then you know that the amount of money that you're getting out every now and then is gonna go higher and higher, maybe little by little, but still. But if you happen to use DRIP within a company that you may not be taking a closer look at periodically, and for some reason they start to decline, then that's a loss of money that you're getting in the long run. So for example, I recently put in 4 or 5 shares of stock in Bed Bath & Beyond, which is a company that sells a lot of home products and pretty much a lot of things. They have a Beyond section, so seriously. But after the huge corporate change that they experienced, their stocks start to decline really hard. Then they would go back up and then they would slowly decline again. So there's a lot of uneasiness to being an investor in a company like that. You're not really sure what's going to happen with your overall income and in comparison to your dividend income. So the amount of money they may offer to their investors in return of dividends on a yearly basis may decrease. And if I'm utilizing DRIP on a company like that, then that's going to look bad on me, especially if I hadn't been paying as much attention to that company and I'm losing money without even thinking about it, instead of taking those dividend checks and putting them towards a company that's actually doing a good job. So that's reason number 2. So reason number 3, if you didn't know, dividend checks are taxable income. Just like the regular income you receive from your job or anything else, it is taxed upon. So when you receive those monthly checks from your company, you know you've already been taxed on it. So you want to be able to use the remaining amount on something that you want to use it on or need to use it on, like rent or mortgage or whatever, but things that you want to use it on. So the last thing you want to do is to have taxable income in the form of dividend checks that are automatically used in a reinvestment program towards a company that you're not interested in utilizing in, but either you're not paying attention or you may not be knowledgeable enough at that moment that you're not realizing it, that it may not be what's best for you. So those are the 3 cons. That's definitely something that you should think about before you decide if you are or if you're not going to utilize DRIP investing. That leads us to the final question that you want to ask yourself. Is DRIP investing right for me? Now I'm going to use myself as an example for this, and hopefully you can kind of use this as a baseline and decide that answer for yourself. So as I've said before, my stock portfolio is in the 4 digits. So I'm in a few thousands right now. I'm just starting off and I'm putting little by little into my stock portfolio on a monthly basis. So for me personally, DRIP reinvesting is a good thing, but I personally have to pay a lot of attention to where the money is going. That's really obvious, but that does require a lot of research. I know I said in a couple of previous videos that dividend investing is very easy, which is true, but I also said that one of the things you do have to be aware of is the company that you're putting your money into. So for me personally, will I actually click the DRIP reinvestment option or however it pulls up on Robinhood in the near future? No. But will I actually use my dividend funds and reinvest it back into my stock portfolio? Of course. Now, how I'm gonna do that, that's gonna be manual, and I would prefer not to utilize fractional shares because it helps me track my dividend reinvesting on my spreadsheet a little bit better. So I will be utilizing DRIP investment in a bit. And I definitely feel like it's beneficial for somebody who has a stock portfolio that's worth in the thousands, definitely maybe 10,000 or below, because your dividend returns may not be extremely high. You may be making a couple $100 or so a year, especially if you're investing in low volatile companies that are giving a decent dividend yield, like in the maybe 2 to 5%-ish. The money you may be getting back may not be enough to pay bills, but it's definitely enough to put back into your stock portfolio. So eventually you get even more money that may eventually be used to pay bills and have fun and do other stuff like that. Now, of course, if your stock portfolio is in the 6 figures, like you just banking, then yeah, you're probably not gonna need to utilize DRIP reinvesting unless you just wanna use it on certain accounts or certain stocks that you studied enough to be able to assume or know what they're going to look like in their future, then by all means, go on ahead and do that. But otherwise, the money you're getting back, you may be lucky enough to be able to use that to pay off certain things or go on a cruise, go on a trip, pay your vacation and dividends and things like that, which is great. That's something I feel like any dividend investor or any investor in general is working for. I know I sure am. So that's my take on it. Hopefully you guys can take what I've said and my base on where I'm at right now and help that determine what you want to do. So with that being said, definitely drop a comment below on how you invest. Do you invest in dividends? How's your stock portfolio looking like? Do you think the DRIP investment strategy is beneficial for you? Pros, cons? Do you have any agreements? Anything. I love having conversations. Please drop a comment in the description below. If you felt like this video is very informative and kind of entertaining, because some of this information can be really boring, so I'm really trying to make it fun, then make sure you leave a like and definitely consider clicking that subscribe button and clicking that notification bell so you can be one of the first to know when I have new content coming out. So yeah, that's pretty much it. Hopefully you guys enjoyed watching this video. Until next Thursday, take care.